Hello friends, today's topic is capital budgeting or capital expenditure decisions. Guys, I would suggest to take a screenshot of this. Say the given question is project costing rupees 20 lakhs, project life is 5 years, tax rate is given 50%, salvage value is nil, depreciation on straight line method, cash flows before tax and depreciation is given for 5 years, first year is 4 lakhs, second year is 6 lakhs, third year is 8 lakhs, fourth year is 8 lakhs and fifth year is 10 lakhs. And we need to calculate number 1, NPV, that is net present value at the rate 10% cost of capital. That is PV factor is given 10%. Number 2 is PI, that is profitability index or benefit cost ratio. Number 3, payback period. Number 4, ARR or average rate of return. Okay. To calculate the net present value, the formula is present value of cash inflows minus present value of cash outflows. Okay. Now, in order to calculate the present value of cash flows after tax, we need inflow column. And in order to calculate the inflow, the formula is PAT plus depreciation. That is profit after tax plus depreciation. So we need to calculate the depreciation first. Okay. Now, in this particular question, the amount of depreciation is not given. We need to calculate on the straight line method. So depreciation equals to initial outlay or initial cost minus scrap value or salvage value divided by project life. Okay. So depreciation equals to initial cost is rupees 20 lakhs minus scrap value or salvage value is nil. So 20 lakhs minus nil divided by project life is given 5 years. So 20 lakhs divided by 5 equals to rupees 4 lakhs. So depreciation here comes rupees 4 lakhs. Okay. So we are opening the third column as depreciation and incorporating 4 lakhs each and every year. Okay. Here the cash flows before tax and depreciation is given. We already calculated the depreciation. So we will deduct depreciation from cash flows before tax and depreciation. Okay. So depreciation to be deducted from this column. Okay. So 4 lakhs minus 4 lakhs is nil. 6 lakhs minus 4 lakhs is 2 lakhs. 8 lakhs minus 4 lakhs is 4 lakhs. 8 lakhs minus 4 lakhs is 4 lakhs. And 10 lakhs minus 4 is 6 lakhs. This column would be cash flows before tax but after depreciation. Now the tax rate is given 50%. So we need to open another column as tax. And in bracket we have written 50%. The tax would be calculated on this column. So nil would be nil. 2 lakhs 50% would be 1 lakh. 4 lakhs 50% will be 2 lakh. 4 lakhs 50% is 2 lakhs. 6 lakhs 50% will be 3 lakhs. So this is the tax column. Okay. Now we need to calculate earning after tax. Okay. This column is cash flows before tax. We have calculated this column from cash flows before tax and depreciation minus depreciation. We got this column. From this column we will deduct tax, we will get earning after tax or profit after tax. Okay. So cash flows before tax, this column minus tax. So nil minus nil would be nil. 2 lakhs minus 1 is 1. 4 lakhs minus 2 lakhs is 2 lakhs. 4 lakhs minus 2 lakhs is 2 lakhs. 6 lakhs minus 3 is 3 lakhs. Okay. So we have calculated earning after tax or profit after tax. Okay. We will open the column inflow, that is cash flows after tax. The formula of cash flows after tax or inflow is PAT plus depreciation. Here we have the depreciation column and profit after tax column. So addition of these two would be our inflow. So in the first year depreciation 4 lakhs and profit after tax is nil. So 4 plus nil equals to 4 lakhs. In the second year 4 lakhs plus 1 lakh is 5 lakhs. So depreciation 4 lakhs and earning after tax is 2 lakhs would be 6 lakhs. 4 plus 2 is 6 and 4 plus 3 is 7 lakhs. So inflow column we have calculated. Inflow is profit after tax plus depreciation. So in order to calculate the present value of cash flows after tax, we need to open one column, that is PV factor. And here the PV factor, the cost of capital is given 10%. So PV factor here is 10%. Okay. Now, how we are calculating this PV factor? Okay. PV factor is also known as discounting factor. R is given is 10%. I would be 10 divided by 100. That is 10%. 10 divided by 100 equals to 0.10. Okay. Now, PV factor would be 1 divided by 1 plus I to the power n. 1 divided by 1.10. So 1 divided by 1.10 in calculator you do, it comes 0.909090. So we are considering the fourth decimal places. So for first year PV factor would be 0.9091. Okay. Then in calculator you simply click on equals to, it comes second year PV as 0.8264. Then again you click on the equals to, it comes for third year PV is 0.7513. Again equals to, it comes 0.6830. Again equals to, it comes 0.6209 for the fifth year. Okay. Now, to calculate the present value, simply you multiply cash flow, that is cash flows after tax, into the PV factor. So 4 lakhs into this, it will comes this value 3,63,640. 5 lakhs into 0.6824, it comes 4 lakhs 13,200. 6 lakhs into 0.6830, that is 4 lakhs 9,800. 7 lakhs into 0.629, it comes 4 lakhs 34,630. So addition of this, you will get present value of cash inflow. It comes 20,72,050. Okay. So we have calculated, friends, present value of cash inflows. You simply deduct the present value of cash outflows, that is our project cost or initial investment, that is 20 lakhs. So 20,72,050 minus 20 lakhs, it comes 72,050. So 72,050 is our net present value, NPV. As because net present value is positive, the project should be accepted. Okay. In case of profitability index, the formula is present value of cash inflow divided by present value of cash outflows. Okay. Now, present value of cash inflow was 20,72,050 divided by present value of outflow was initial outflow, that is initial investment 20 lakhs. So divided by 20 lakhs. So rupees 20,72,050 divided by rupees 20 lakhs, it comes 1.036. So if the PI is greater than 1, the project should be undertaken or the project should be accepted. Okay, friends. We will calculate number 3, that is payback period. Okay, friends, to calculate the payback period, we are having two methods. One is traditional method, another one is discounted method. Now, what is payback period? Payback period means a period or the number of years a firm expects to recover its original cost, that is 20 lakhs, from its cash inflows. It's traditional payback period method. Here, considering the cumulative inflow column. So you check it across the inflow column, 4 lakhs. So you write this 4 lakhs here. Now 4 plus 5, that is 9 lakhs. 9 plus 6 is 15 lakhs. 15 plus 6 is 21 lakhs. 21 lakhs plus 7 is 28 lakhs. So friends, here we are opening the cumulative inflow column. So simultaneously, friends, you can open the cumulative PV column also. First year PV is 3,63,640. You copy and paste it across here. Now with this you add the second year PV, it comes 7,76,840. With this you add the third year PV, you will get 12,27,640. With this you add the fourth year PV, it comes 16,37,420. With this you add the fifth year PV, it comes 20,72,050. In order to calculate the traditional payback period method, we would focus the cumulative inflow column. Okay. Now break it across where the 20 lakhs would be recovered. Now you take a pencil and you write 20 lakhs in between 15 lakhs and 21 lakhs. Now, so it is in between third year and fourth year. Okay. So period you write equals to 3 plus, you put a by over here, 20 by 21 lakhs. You copy this and paste it across, 20 lakhs divided by 21 lakhs. As because this is an interpolation method, this 15 lakhs would be deducted from both. 20 lakhs minus 15 lakhs, 21 lakhs minus 15 lakhs. So it comes 3 plus 5 lakhs by 6 lakhs, it comes 3.833 years. Okay, friends. In order to calculate the discounted payback period, we would consider the time value of money and we would take the cumulative PV column. Okay. Take a pencil, you write 20 lakhs in between these two. Okay. So firm would recover 20 lakhs in between fourth year and fifth year. So we are writing 20 lakhs over here. So fourth year plus, so equals to 4 plus. So 20 lakhs divided by 20 lakhs 7250. So 4 plus 20 lakhs divided by 20 lakhs 7250 minus 16 lakhs 37 to 420 from both the sides. 16, it comes 4 plus 3 lakhs 62 540 by divided by 4 lakhs 34 630. It comes 4.83 years. So that is average rate of return or ARR. For average rate of return or ARR equals to average PAT divided by average investment into 100. Average PAT means total profit after tax divided by project life 5 years. So average total PAT is 8 lakhs divided by project life is 5 years. So it comes 1,60,000. Average investment means the formula is initial investment minus scrap value divided by 2 plus scrap value plus additional working capital. Initial investment here is 20 lakhs. So we are writing 20 lakhs. There is no scrap value. So minus nil divided by 2 plus scrap value is nil. There is no additional working capital. So here again it's nil. So 2 lakhs minus nil divided by 2 plus nil plus nil. That is 20 lakhs divided by 2, that is 10 lakhs and into 100. So 1,60,000 divided by 10 lakhs into 100 is 16%. So friends, we have calculated the net present value, profitability index, payback period and average rate of return. All the very best, friends.